Does money supply growth create real economic growth? Imagine a country suddenly printing more money. Does that mean the economy is actually producing more goods and services? Or is it just making prices go up? That's the big question. Money supply includes all the cash, coins, and bank balances in circulation. When more money is available, people might spend more. But does that lead to more stuff being made? Not necessarily. Real economic growth means more goods and services, adjusted for inflation. It's about actual production, not just higher prices. The core idea here is the quantity theory of money. It says that over time, increasing the money supply mainly affects the overall price level, not how much the economy produces. If the amount of goods stays the same but money doubles, prices tend to double too. So people have more money, but what they can buy stays the same. Inflation is when prices rise across the board. If the money supply grows faster than the economy's ability to produce, inflation usually happens instead of real growth. That means your dollar buys less, even if you have more of it. In the short term, things can look different. If an economy has unused workers and factories, increasing the money supply can boost demand. Businesses respond by hiring more and making more goods. But this boost doesn't last forever. Once full employment is reached, more money just pushes prices higher. It doesn't create more real output. Different economic models show varying views. The neoclassical model suggests that only unexpected changes in the money supply affect real output temporarily. If people expect the change, prices adjust quickly, and real growth doesn't happen. The Keynesian model argues that both expected and unexpected money supply changes can influence real activity, at least for a while. Evidence shows that the link between money supply growth and real economic growth isn't clear-cut. During recessions, more money can help stimulate activity. But in normal times, the main effect is inflation, not more goods and services. Central banks like the Federal Reserve watch money supply growth closely. They aim to keep inflation low and stable. If they see money growing too fast, they might raise interest rates to slow it down. If the economy is weak, they might allow faster growth to boost demand, but they know this risks higher inflation. Inside money, created by banks through lending, is more connected to real economic activity than outside money, which is created directly by the central bank. If banks lend more, it can support some growth, but only if borrowers are willing to take on loans. From the inflation perspective, the main takeaway is that increasing the money supply mainly pushes prices up, not real growth. Short-term boosts can happen if there's slack in the economy, but over the long run, more money usually means higher prices. So, does money supply growth create real economic growth? Not reliably. Its most consistent effect is on inflation. Policymakers need to balance stimulating the economy with controlling rising prices. For viewers interested in inflation, understanding this link helps clarify why more money doesn't always mean more stuff.